Let's give a breakdown on PV10. I've had some questions about it. So what is PV10? PV10 is the present value of estimated future oil and gas revenues net of estimated direct expenses and discounted at an annual rate of 10%. In layman's terms, it is what it's doing basically usually 10 years out, and you see a 10% discount or 10% drop every year. There are a multitude of factors in this, price, decline curves, things of that nature. But this is the basics of it. Investopedia has a full article about PV10. I highly recommend you go check it out. If you Google PV10, what is PV10? It'll talk about it in great detail. This is kind of an overview. The basics of PV10. It's a method of estimating an energy company's potential future earnings based on its proven reserves of oil. So you're going out past what it's already producing to get a general idea of what it will produce over the coming years. Is based on engineers' reports of potential costs and revenues that the reserve may produce. You got to factor in a multitude of things. And it is widely used by stock analysts and investors as a measure of energy companies' market value. One key problem with this is if you look at the fine print, typically investor relation presentations with companies have inflated PV10 oil price numbers, and that can get sketchy. Ring Energy is one of them. They are running a very high PV10 number, and it's not, I don't like it. I think it's a little misleading. But also engineer reports, those can be tricky as well. Engineering reports have single-handedly had the biggest burning of capital in the history of capitalism with Shell, based on their quote-unquote PV10s. So take it at your own will. This is general. What is PV10, by the way? I could go off on a soapbox, but just to give you an idea of what PV10 is, what people look at it as, and conventional assets, legacy assets, typically run on a PV10 type deal. Horizontal oil companies try to present in a PV10 type deal, but it is extremely misleading because of the decline curves, things of that nature. And to that note, key traps when you're using PV10 are the decline curves. You need to look at the decline curves of an asset and see what they're actually declining. A horizontal well can have an 80% first year decline curve. So if you're only taking out 10%, that makes it rather bad. If you're only expecting 10% and the asset drops production by 80 or 90%, that's not good. Water-driven formations, typically more water will come in and thus higher operating costs because you are disposing of more water. That's always something to consider. Major equipment issues, I see it all the time. Guys buy wells and they do not factor in the fact that they're going to have to start replacing bearings, pumping, pump jacks, casing, holes in casing, a multitude of things. You got to remember these older wells, they're exposed to salt water, the elements, all of these things, so stuff is going to start break down. Equipment definitely is something that you have to factor in when looking and valuing a property, because nothing lasts forever, and the equipment costs and repairs, electrical cost repairs, they can eat you alive if you do not catch them before you buy it, and make sure that is represented within the deal when you close. Think of a house, buying a house, and you didn't really check the pipes. Next thing you know, you own the house and the air conditioner's breaking, the pipes are bad, you're digging up the foundation. Same scenario. You really got to pay attention to the equipment when buying, because stuff does go wrong, stuff does break, and it will become an issue. And as I've said before, say it again, PV10 is not designed for horizontal. Some guys swear it is. It is not. When you're factoring a 10% decline every year due to expenses and stuff, it just does not work for it. And last but not least, let's take out a real quick spreadsheet. I'll make it with you guys so you can kind of get a general idea when looking at production as well. Hey guys, before we get to that spreadsheet, please like and subscribe to my channel. It helps me out a lot. I appreciate you watching them. I hope they help you out a lot. But again, please like and subscribe. So let's make a very simple PV10 spreadsheet here. This is Excel. Assuming you have Excel, this is how you do it. So first, we obviously need to have price. And let me again state, along with the rest of this video, this is very basic to give you an understanding of how to kind of dive into this part of the business. And this is very much for conventional assets with steady declines, not steep declines like Shell. So first, we need price of oil. And we can say 20 bucks. This number will change here. So need barrel of oil per day. And this is the starting barrel of oil. If you're looking at a deal, this is what it's at now. We'll call it 100 barrels. Then you come over here, and what you are doing is, this is the price, this is the daily production. So this is the price, this is daily production. So over here, equal, and this is, you may want to look at how to make various equations, things of that nature, but what we're going to do is barrel of oil times the price times 365 days. That's just general. So this, change it to numbers. So that will gross 730,000. This number and this number can change. So if you want it $30, you can see that number changes very rapidly. Same with this, if you want 50 barrels a day. To give you an idea, these numbers, these two numbers, you can change to whatever the deal is. Now with PV10, you are going to have a 10% loss every year over 10 years. So it is equal to this times 0.90. So basically 90%. And then you hit enter. So this is after 10% of that. Hope this makes sense. And this is all it is, and then you can drag to the 10. So you have year 1, 2, 3, 4, 5, 6, 7, 8, 9, year 10. These are the years. And again, this is very basic, but it just gives you an idea. So over the course of 10 years, if it only loses 10% a year, it will produce, produce roughly $3.5 million. This is the basic premise of a PV10. There's a lot more to it though, because obviously this is gross. You've got to factor in mineral owner payment, severance tax payment, operating and lease costs. You've got water, if it's got water drive, fees, all kinds of stuff. But this gives you a general idea of where you're at. So when you're looking at a deal, you go on and make the spreadsheet out, and then you can come in, and if you're looking at a deal and it's 5 barrels a day and oil is 30 right now. See, and there it is. Now the trick is, and the fight is getting that price as low as possible, because that's leverage for you in arguing the deal. Like right now it's like 10 bucks. As you can see, this price goes down even more, but you know, when they're selling overall over 10 years, it's not crazy to think that oil won't average out to say 55 barrels. So 5 barrels a day will come out to roughly, you know, $653,000. This makes sense. This is very generic, but it's a cool little thing you can make and save, and then you can just, like I said, go back and change this $75 oil, 2,000 barrels, so that's way too big, you know, but give you a general idea. So I hope this part helps, and let's check out some other stuff on PV10.